Maybe I should.
All right, everybody. Welcome back. We are live, Kevin. We are live on LinkedIn, on Facebook, and YouTube, and anywhere else that the stream will pick up the signal. So, everybody, welcome to the 2025 Mortgage Market Outlook, Insights and Predictions, and I'm joined by my friend, Kevin Peranio, Chief Lending Officer at PRMG. Kev, how are you?
I'm good, buddy. It's my second guitar intro on a podcast I've had in 2 weeks. This is awesome.
Well, I didn't do this one myself, so I saw you last week. I was like, I was gonna get my rig in here, and I was like, I just didn't have time, man. I just didn't have time. You know what I mean? I was like, okay, I just gotta. Next time Kevin shows up, I'm gonna have everything ready for him so I can blast his ears with my stuff. I will not be outdone by somebody looking for the next lead. Listen, here's the weird thing: you're on the West Coast. I'm on the East Coast. I'm in a T-shirt. You're in a coat. I mean, it feels kind of odd, no? Yes, optically.
Yeah, and it's actually kind of nice. The Santa Ana devil winds are blowing those fires all around up there in LA County, a little bit north of us here in Orange County. They've died down a little bit, and it's pretty calm here today. It's actually a nice day, man. It's always such the paradox, man. You have this crazy weather, and then next thing you know, it's beautiful. In LA in the midst of a bunch of devastation. So, I may shed this coat later, but I feel for you everywhere. This country is getting a ton of crazy weather right now. So what a great start to the new year weather-wise.
Listen, I mean, I've been dying for snow out here in Northern Virginia, DC metro market for a couple of years. So God listened and gave me 10 inches this last few days. And I said, okay, I need now lower rates. If you could listen to that prayer, that'd be great also.
Yeah, it's coming. It's coming.
It's coming. Hey, listen, so overall, I mean, you guys are okay in California. I talked to my niece. She's 10 miles south of Culver City or Pacific Palisades. So I think she was okay. Or you're okay, guys, right? I mean, looks like you're
us in our home here in Newport Beach, kind of in the middle of Orange County, which is the county just below Los Angeles County. We're doing good. Just a bunch of leaves all over our place and a couple blown down branches. Just another chore to do this weekend. So I'm not going to complain when, I literally just got off the phone with, I do some construction on the side as kind of a side hustle. My buddy and I went to University of Texas together. He lives in Malibu Canyon. And so he's got a red flag evacuation through tomorrow. So he packed up his wife and 3 young kids, and they went north up to Oxnard, which is kind of near Santa Barbara, and then they're going to head into Rancho Mirage, which is like Palm Springs, La Quinta, the desert area. He's going to go there for like a week. They have a rental house that's empty for a week, and then before that, I had a Housing Wire podcast taping with Sarah Wheeler. She wanted to know how businesses are trying to deal with just all the stuff that's going on right now, and right before I got on the phone with her, I was with a lady who lost her house in Pacific Palisades. She lost everything except her dog and what she could pack in 2 rollerboard suitcases in 35 minutes. And, you just trek a half mile down the hill to PCH because everything was blocked off, and hop in a Toro car that she had rented. And she came down here to Orange County, and, she's displaced. And I'm going to let, I got connected to her through Picasso, which we're both second home co-owners together, and I'm going to let her use my condo in Rancho Mirage for the next month, just so she can get stabilized and get on her feet. So, yeah, it's hitting home, even though I'm not in the path. It's just it's what we all do here, man.
Yeah, you're nearby. I mean, that's the thing is like I said, my niece is like literally 10 miles from Pacific Palisades, so she can see the smoke, and hopefully everything is going to be okay sooner. You know what I mean? So we'll just pray for the best. But right now, let's pivot back to our market right now, because that's what we're about right now. In this particular episode, we're going to make some predictions, some outlook. I like the word outlook better than predictions. Predictions seem so like kind of.
Me too. I don't want to be wrong again and again.
Yeah. I'm getting tired of this feeling, right? Because just for the record, I know we were all busting Barry's chops a couple years last year, whatever that was, but I thought it was going to be February 2024 that we'd break out of this cycle that we were in, right? So clearly I was wrong, and then I don't want to get into what happened, but I was wrong, and it cost. So you are the Chief Lending Officer at PRMG. So tell our audience, I mean, what does that title really mean? I mean, I've seen that title around a few times, but what does that mean?
So I've been with the company 14 years, and when I joined, I was living in Fort Lauderdale before moving here 9 years ago, and I have had a great team surrounded with me. 3 companies now: First Magnus and North Star Lending. I was an owner of that company. I got into that company for about 3 years, and then they just ran into some troubles during the financial crisis, 07 to 10, and then I linked up with Paul and Robert, the founders. Paul Rozo, he's Colombian, and Robert Holliday, the founders of Paramount Residential Mortgage Group, and we're a 3-channel lender. And our division and team out east that was based out of Fort Lauderdale, me and my team, we were growing, we were crushing it. We were really doing well for PRMG, and they asked me to be their partner. So I'm also an owner, and they asked me, about 9.5 years ago, move to California, be our partner, help us grow everywhere. What do you want to be called? I was like, call me KP. I don't care. No, your title. Oh, well, because nobody could say my last name is Peranio. So right. I just go by KP. So I don't have to put everyone through the pain. Yeah. As you know.
My nickname is Bobby. I don't want to go through all the rigmarole of what my real name is.
Yeah, I know. And so, we have 3 channels in helping with sales leadership and all those channels, and really bringing harmony between ops and sales, which I think is the secret sauce for every origination team. Yep. Whether one person show, female or male, originator, processor, broker, burgeoning independent mortgage banker, correspondent, you name it, lender, 3-channel lender like us. You gotta get ops and sales on the same page, and that was always kind of our secret sauce. Just driving people to find solutions, right? And so when I got here, so there's a chief lending officer, but when I got here, I realized that technology plays a really big role in bringing that harmony between ops and sales, and of course, so yeah, they made me the partner. So I have my visibility and eyes on everything there. Obviously, I don't have to work the lock desk or do cap markets, although 2 companies ago I was hedging, and I had a team, and we set up our mandatory desk and all that. So I'm familiar with all this stuff, and I have my eyes on it, see the financials, and come up with strategy and all that. So, but my focus is just overall lending, right? And so I guess probably the best way to maybe say what I do on a daily basis is I have 5 direct reports, and trust me, they don't feel like they're my direct report. We all work together, but the channel director for wholesale, retail, and correspondent. And then we have a digital lending director, and then we have a performance marketing director. And performance marketing is like our ROI driven tactical marketing team. And so those are the 5 teams that and directors that I work with directly. And there's just so much that goes around all that, and driving the roadmap, pushing the vision, doing demos, trying to find out what's coming. I mean, everyone's talking about AI for 2 years now, when ChatGPT blew on the scene, and now AI is being implemented, and like we're actually using it to do stuff. And so, how do you do it? What do you do? How do you prioritize it? Where do you put it on the roadmap compared to a new website or something the compliance team needs? It's just never ending.
Let's go back to ground zero for a second. And I hate to say that in California right now, but let's go back to ground zero, right? Like, what's one big takeaway? Look, 2024 just ended. So what's one big takeaway KP is going to take from 2024 into 2025?
When you look back on it, regardless of what you did, it was a tough year, but there was progress and growth and more loans, quite honestly. So it was a win. It doesn't mean it was easy. Nothing ever is. The only easy day was yesterday. I learned that from Navy SEAL Brent Gleason, who's been a speaker at our sales rallies multiple times. Great dude. And so we have a lot of momentum and positive energy rolling into 2025, which should be an even bigger growth year. So we're projecting 24% growth across all three channels.
Mhm.
And, all ships rise with the tide. If there's more business, then everyone will do more business. And it will feel busier and ultimately will be better for the results because there's less competition.
I know that we're going to talk about outlook for the market, but it feels like more companies, and I say this with the view that I have, and I don't want to minimize or make myself larger than I am, but whatever the view I have, it's a little bit more than other people have. I get that. I get to talk to a lot of people, but most companies have created a process that looks like it's geared for 2025, and it's ready to take on that 20 to 30% extra volume. Is that a fair statement?
I think so. I think I'm really hearing of a lot less layoffs and more beefing up the team. And so, January and February are seasonally slow, and we have high rates right now. We're back to the April peak on the 10-year Treasury, although the rates aren't as bad as they were in April because the 30-year mortgage 10-year Treasury spread has come in. So that's a nice tailwind. Rates are the driver for everything. I mean, for me to zoom back out and kind of just lay it out flat, we buy and sell money. And when there's more money and more flowing capital and money gets cheaper with lower rates, it's better for home affordability. It's better for business. It's better for volume. It's better for everything, which is why we talk to death about all the data that comes out every day. We lock loans every day. We deal with loans every day. We work, transactionally. I'm not saying we don't connect and build relationships, but the secondary market is cold, heartless, and unforgiving. And if rates are up, then all the Wall Street analysts are going to be like, okay, well, don't buy this stock or that stock because rates are up. And when rates come down, like, okay, buy it. And at the end of the day, it is the driver, and so is capacity.
It does feel like we're reacting, and I notice when I listen to your I think it's 14 minutes. Sometimes you go on longer on the LinkedIn things.
15's a cap. If I do 15 minutes, it won't let me upload it. If I do 14:59, it lets me upload it. It used to be 10. Okay. So I apologize in advance, but people actually listen to it. I'm kind of shocked.
It's very informative. I mean, it's a good way. You have it on the back while you're working, and you can pick up a few things. So it feels like most loan officers are reacting to the market. Whereas, secondary market, capital market guys, they are kind of seeing something in the market and they begin to hedge, they begin to pivot, they begin to make decisions based on what they're seeing could possibly happen. So two different views, right?
Well, I mean, if you're an originator and you're talking to a borrower right now, can't lock them at 8% if it doesn't make sense on a refinance or if it's out of their budget. But if next month it's 7%, and they're in the money and they qualify, well, then you're locking them and you're closing. So we are always reacting to rates all the time. And so, but you don't sit around and wait for rates. No one does, and it's very busy. There's 300,000, 200,000 less loan officers than there was 3 years ago. Even 4 years ago at this point, if we say 2021, that this industry, rates hit the lowest level ever in February of 22. And then from February to June, they shot up and peaked out, what would you say, of November of 22. Last half of 22 was brutal. And a lot of layoffs. A lot of people quit the business.
A lot of layoffs.
And realtors left, and the realtors had their NAR settlement. The National Real Estate Realtors, they had their settlement and for $1 billion, and a lot of realtors, got out, and there's a lot of realtors that kind of moonlight as realtors and don't produce. But
I'm hoping that the days of the smaller realtors might be coming to an end. We'll see. But Kevin, let's go back to the reports here. There's a ton of reports out there. Ton. I mean, especially like, you subscribe to Barry stuff or Hammer stuff, you start getting inundated more and more. And like, is there a report that you count on a monthly basis? Like you're waiting to see this report and that's going to let you know what this market could be heading into. What is your pet peeve report?
Yeah, I would say, and this isn't a knock on you.
I didn't mean to say pet peeve. Your favorite report.
Sure. Yeah. I mean, that, this isn't a knock on anyone else, but there's nobody who does it better than Barry and Dan. They just have connections to people that are analysts. They have connections to Fed governors and economists, and they have the best information and data. And so, as former originators, they're able to speak the language of the mortgage business. And so, I love their stuff. I will formulate my thoughts for my LinkedIn stuff based on just nuggets that I read, and mostly where I'm reading are stock analyst reports. So, give me an example. So, Louis Navalier, Platinum Growth Club, they give stock advice. And again, I am not a financial advisor. I am not responsible for your losses, only your profits. But these people want to make money, and so when they look at inflation, they look at it from a different light. They're not trying for it to be better rates because that's what's better for all of us. They're not hopeful, which I love the optimism, but they call it like it is. Tom Lee, Fund Strat Advisors, he's on CNBC all the time. I subscribe to all their insights. And it's funny because Stansberry Research, Investor Place, I could go into all the stuff that I read. I get newsletters all the time, and I copy nuggets from them, and I kind of read it and I formulate my thoughts. And then, sometimes right before I go on Monday or Thursday night and do my LinkedIn, I'll watch Barry and Dan just to see what they're thinking and maybe pick up a nugget. And if I pick up a nugget from them, I always give them love and shout. I like Logan Motoshami as a housing analyst. He really breaks down the charts. He has a cadence and certain data points that he looks at, and he has a mindset that is unique.
Housing Wire, right?
Yeah, he's the lead housing analyst for Housing Wire. His Instagram feed is fantastic, and so he looks at charts throughout the day, and he looks at the 10-year Treasury, and he talks about what goes on. And so there's some, if I garner a nugget from him, I'll give him a shout out as well. But overwhelmingly, my data comes from stock analysis and analysts. And so, just for an example, Tom Lee at Fundstrat, he's been saying for months, inflation is falling like a rock.
Mm-hmm.
So he said, inflation is falling like a rock. Now, if I have another stock subscription service where the guy is a complete bear, he always does bear puts, bear calls. He does market spreads. He sends me these trades. I stopped trading with him because he's so overwhelmingly bearish that he's wrong when the market goes up. And so, we had a PMI global number come out, ISM manufacturing number come out, and he says, inflation is going up. Inflation is going up. I have another guy, in Stansberry Research, guy Greg Dime, is amazing. He does good trades. He is like, this market is going to sell off. Inflation is going up. It's here to stay. But you listen to Tom Lee, he says, or Ivy Zellman, who Barry introduced me to. She's an amazing researcher. Zellman and Associates, who was bought by Walker and Dunlap. We give them all of our data and reports every month, and I get all of their reports in exchange. They said that the owner equivalent rent number went down last month by 14 basis points, month over month. It's the second biggest drop in inflation for owner's equivalent rent ever. Yeah. And so who's right? Who's right with all this confusing data out there? If you listen to one person, you anchor to that one person and they're wrong, you're wrong because you didn't get data from 10 different sources. And it's hard to do because we all got full-time jobs. I got 4 kids that my wife, thank God, takes care of, but when I'm home and I'm around, they're a nightmare, right? And then, they're amazing. I put my phone down because my 9-year-old daughter wanted to read corny jokes for 10 minutes to me. So I put my phone down so she sees I'm engaged. And she said, why do people tell secrets to herbs? Because only time will tell.
Oh my God.
So I can't get that moment back, but that's 10 minutes of listening to corny dad jokes where I put my phone down for a second. But, back on point,
so I want to connect the dots here for the listeners who are listening, right? Inflation coming down, inflation not coming down, inflation going skyrocket, inflation dropping like a rock. Why is inflation so important to our mortgage rates? Just in case somebody doesn't know.
So where you and I were wrong a year ago, we thought we'd be out of this by February. If everyone recalls, the CPI, the Consumer Price Index, spiked in January, February, March. So when the reports came out in February, March, and April, the 10-year shot up. And that's why we had that 473 peak in the 10-year last April, because we had 3 months in a row of rising inflation. So it wasn't like, oh, it's just a 1 month thing. It was 3 months of it. So, and the cuts started slowing down. They weren't 75 basis points cuts, 50 cuts. They were 25 basis points cuts. And then they skipped a cut, last year. And then they finally stopped in July. A raise for the Fed funds rate. So stuff like that matters because it does impact, like in December, we put our budget together for the year and we say how much business we're going to do in all three channels. And then we forecast for the year and then we reconcile our budget every month. Okay, January is not going to be as good or February is not going to be as good as we thought in December because rates spiked up last spring for the reasons we just said. So for us, is my staffing all right? Do I need to hire into this? My locks obviously are a forward indicator of the pipeline in the next 45 days. But this data matters, and it matters for how we run our businesses, especially at a large scale. I wouldn't call us a large lender, but we're a top 20 lender with 3 channels. And so we have to be mindful of that, and it has to do with your hedging costs and how much, coverage you take out to, cover your 83% lock pull through. Do I need to pull down the 83%, or are we pulling through more or pulling through less because rates are going down, in our cap markets hedge? These things matter. I mean, these are millions of dollars. So
I've always been told that the inflation is like the worst enemy of the bond market. I think
it was.
Carville, the Democratic strategist, said, if I come back, I want to come back as the bond market, or because it's not afraid of anything other than inflation, something like that. You know what I mean?
Well, the Fed has a tri-mandate. Everyone says a dual mandate, but it's actually they have 3 mandates. And the one that no one talks about is moderate long-term interest rates. That means the 30-year and 20-year long bond. And those are rising, by the way. They're both up over 5% yield. So paying back our debt and deficit when there's $10 trillion of treasuries that need to be sold at auctions by the Treasury and the Fed this year alone, with a budget coming out of DC in March that we don't know about yet, that is a big deal. The other mandate that we hear about the most, the dual part, is stability in prices, inflation, and lower long-term unemployment. And so all the way up through September, when the Fed did a dot plot, and then they did their first 50 basis point cut, which I want to bet on, saying that it would be larger than 25 the first cut. It was nice to get something right in my predictions / outlook. They said we are now looking at labor because they feel inflation is solved. Now, when I say solved, they're not at the 2% target. A lot of people get fixated on this 2% target.
Yeah.
Like, it's got to be 2 or else we're going to not cut anymore. And that's not the case. We're totally comfortable with core PCE, personal consumption expenditure, the Fed deflator, the one they look at the most, not CPI, not PPI, PCE, core PCE. They're totally comfortable with that being in 2 to 2.5% range. They're totally comfortable with that. That's where it always is anyway. It's almost never at 2%. Literally, it's 2.4% is the 40-year average. So what they said is we're looking at labor now, because if labor breaks and there's nothing worse and more deflationary, outright deflation, right, than if someone's income goes to 0. So when there's no consumer income and they can't pay for goods and services, which is 70% of our GDP, that's deflationary. So there's a big difference. Like, we talk about inflation, and when we say inflation is coming down, the rate of it going up is coming down. It's still going up. Everything's still getting more expensive at a 2.7%.
I think that's the point that people don't really understand, is that and living in DC, I understand some of the jargon a little bit better. Not that I'm into it, but I know 20 years ago I was really into it, but I've kind of like distanced myself. When they talk about certain ways of coming down, it's not coming down. It's just not going up anymore
as fast
or as predicted. You know what I mean? And
the term they use is disinflation. So the rate of it going up is slowing. So that's disinflation. But outright deflation is horrendous for our economy, which is why jobs and job losses is a big deal right now.
So the question comes down to this, Kevin. We are January 9th, 2025. I honestly don't know where the rates are. I think they're in the sevens. My gut says that's what I'm seeing what my loan officer's talking about. You know what I mean? Give or take.
Yep.
Some programs are in the high sixes, low sevens, whatever, right? Where are we going to be at? If there was a channel that you could say, Fab, I really think this is where we're going to be at in the next 90 to 120 days. I think that gives you a pretty good runway, right?
Yeah. No, I like that. I like that runway. I am totally on the same page with Barry and Dan. You know, these indices and index, you know, they're 12 months of monthly readings stacked against each other. And as soon as the January 2024 number comes out of the core PCE, which is like 0.43%, and that gets replaced with a 0.22 or a 0.27 or even a 0.3, we go from 2.7 to 2.6. And then so the January, February, and March numbers of 24 were pretty elevated. And if they win, they get replaced by the current pace that we're on, which is 0.22, 0.27. Okay. When they get replaced, we get the report in February, in March, in April. That 2.7 overall 12-month running index for core PCE will be coming down. It might go up this one coming up in a couple of weeks. It might go up to 2.8, 2.9, but then it will start to come back down, and we'll probably sit at about 2.4 when we're sitting there talking about this stuff in April. And a 2.4 core PCE is the 40-year average. So going back to Tom Lee, inflation's falling like a rock. And so, look, that's between now and April. What are we going to do between now and then? We're going to keep grinding and doing loans and finding business, and the tailwinds will continue to muster, I think, on rates over that 90 to 120 day period that you gave me. And that is based in data and sound logic, and I believe in that. And so I
2.4 core, we're looking at about a 6.25 rate market.
Well, so if the 10-year Treasury starts to come down, because don't forget, by April we'll also have a budget. So we'll have some,
hopefully.
Yeah. Well,
right? I mean, they could kick the can down the road another 9 months. You know that. I mean, it's not like
the single biggest driver of inflation is government fiscal spending. And the Fed has said repeatedly, we only do monetary policy. So DC's got to fix fiscal spending because we're on an unsustainable path. We have a continuing resolution that got passed, took 3 rounds to pass it. That's good through March 15th. And Trump is not in Congress. Trump does not pass a budget. Trump is not in charge of that. Now,
neither is the little Doji guys, by the way, the Elon and Ramaswamy, whatever his name. I'm sorry.
The first buddy.
Yeah, first buddy.
Yeah.
I mean, they're just giving advice on what they feel should be cut.
So Department of Government Efficiency, the goal is to cut out $2 trillion from the budget over 10 years. That's $200 billion a year. We've got like a $4.6 trillion budget. 1.5 trillion of that is Social Security. 1.1 trillion is just interest payments on our debt. And about 900 billion is Medicare, Medicaid, health services, and 900 billion is defense spending. There's very little discretionary spending above that. So if they cut out 200 billion from the 4.6 trillion current budget, which started October 1st, and they've already spent 1.4 trillion, we've added 25% or more of our entire country's history's debt in the last 4 years.
Jesus.
And we had COVID. But I find it funny that in the December Fed meeting where they did their dot plot and the minutes came out yesterday, suddenly they're all talking about tariffs and the budget. Like, why didn't they talk about the last 2 years? We were spending like a drunken sailor. Okay, 20 and 21, I understand COVID. But what about the last 2 years? But all the focus was on inflation while we were spinning like crazy over here on the side. So
we have a standing policy on the show, Ken. We don't go dive into politics.
No. I'm speaking fact. I'm speaking facts.
What happens is the show turns into a 6-hour diatribe by Fabi Nagmi.
Yeah, I'm just speaking facts. Like the Fed said in December that we are worried about fiscal policy. So all of a sudden there's this super heightened, so much so the 10-year treasury has gone up 100 basis points. We're at 470. After 100 basis points of Fed funds cuts, that has never happened. We've never had 100 basis points cut and then 100 basis points increase in yield. It's never happened. Something's got to give. And so yeah, the Trump administration, the executive administration, I mean, people have to exercise some emotional intelligence here. We're talking facts. We're not, people get triggered when you say Trump's name. People get defensive. People get triggered. You say Biden's name. Like the reality is, the House of Representatives comes up with the budget and they pass it. It goes to the Senate and the Senate redoes it. And then they kick it back to the House and then they redo it and it comes back to the Senate, so like varsity and JV. And then they pass a budget, hopefully in March. And the big talk right now is, do we pass one big beautiful bill where it's the budget and the tax cuts being extended, which is inflationary, right? If there's less revenue coming in to the Treasury because we're not collecting so much taxes because the tax cut, that's inflationary. But if the outcome is we take our $29 trillion GDP which has a $36 trillion debt on top of it, 123% debt to GDP. If we keep that debt stable and then we grow our GDP, maybe because of the tax cuts, maybe because of tariffs, maybe tariffs blow up in our face. I don't know. On Monday, the administration said we're going to have targeted tariffs and we're going to be very selective. And the market reacted to that positively. Stock market ripped. So do you pass one bill or two? Do you do the budget first, then the tax cuts? Trump's no dummy. He's not the one passing it. He's not the legislative branch, but he knows his mandate from having the popular vote and winning the Electoral College in a landslide. They say the first 90 days is like his window. So he's trying to do it all at once. And so he's been, he's had people come to Mar-a-Lago. He's having people talk. He's having Senator Thune, who's the majority head of the Senate, Republican, Speaker of the House, Mike Johnson, Louisiana, who just got, took 2-3 rounds of votes to get in. He's wooing everyone to try and get one bill passed as opposed to two because it'll be harder to do two. They're probably going to do two.
Do you think, like with loan officers, let's take a pivot here real quick. With loan officers and where the market is and all this kind of like all these possibilities, right? If I'm a loan officer and let's say I'm in my 6th or 7th year, right? I've survived all these years. I'm still here, right? Maybe my production used to be 20 million and now it's down to 9 million. Something reasonable, right? I don't know what the numbers are, but what does the loan officer do at this point, Kevin? I mean, when we hear all this kind of stuff, you know what I mean? It's like almost like you don't want to get out of bed.
Well, let me just say this. Let me put my originator hat on. If I'm on the phone with a consumer and they bring something up like what we're talking about, you better have a fucking answer.
Yeah.
Okay? Because that consumer, they may not know everything about everything, but if they think they know something about something and you don't have a way, you know what? We can't control what's going to happen in DC. I'm positive that they're going to pass a budget in March, which is good for rates. So you can start talking about date the rate again. We've been dating the rate for a year, and no one's really no one's ready to. Yeah, it's tough. Everyone's ready to go on to the next level.
It's not hit the national average of marriages in America, by the way, before the divorce happens.
Yeah, over 50%. But you better be able to answer the question when your consumer brings something up. And so having a well-rounded knowledge of what's going on is important. There are so many single issue voters at the elections. There are single issue thoughts that consumers have on the economy. And you better believe that half the people you talk to are going to bring up the word tariff. They're probably afraid to buy a house because of tariffs. You better know that on Monday, Trump, before even taking the office, said, we're going to have selective and a lot less. And the bond market and stock market reacted positively to that. And you should too. Worse than it's less than feared. So that's where it matters for an originator. I was an account executive when I started this business, a damn good one. Good originators came to me to solve problems. I had to know my shit. And so, being able to have these conversations and talk matters.
What other tips? I mean, you've been in the industry a long time. I mean, I've been in the industry a long time, but By the way, I just celebrated 31 years last Saturday. 31 years in this mortgage business, brother. Think about that, man.
You got the gray hair. Prove it.
Thank God I'm still hanging on to it. But,
Yeah, I got a guy that dyes my hair, so my hair matches my energy.
you look great, man. You got matching coat to go with your hair. I got a matching T-shirt to go with my hair, so we're all both good. So listen, brother. What other tips do we give loan officers? I mean, I know I've got my team focused on, TBDs, a lot of TBDs. Like, get the guys in, lock them down, because when the rates turn and they're out there house hunting, you don't want to be on the back side of that line.
100%.
So get them in now, get them in before, and get them committed to you and to win that deal. What do you think about that strategy?
100%. And you know what's even better commitment? Skin in the game. A lot of people are afraid to charge their borrowers for credit reports. It's $80, $60, whatever your company charges, going up, of course. But get some skin in the game. Get some hard money from your consumer. Get them pot committed, right? You don't have a property, so you can't charge it for the appraisal, which is another way to do that. And you get that process going. They're less likely to leave you. The TBD is great. You're sticky. You had a good conversation. They may leave you. You may lose touch. So skin in the game is important. And don't be afraid to ask for someone to pay for a credit report. Hey, let me get your.
In the old days,
that's how it was.
In 94, 95, I used to take a check for $350 at the time of the application. I just remember that when you just said that. You know what I mean? And they would write me a check. I stick that in the file. I give it to my I had no idea what happened to the check. Right? It was made out of the company. But I don't know, man. But they were committed. I knew that we were going to move forward. That's a great idea. Get more sticky to the file.
Yeah.
Did they pay for the credit report with the current system, or is it? How does that work?
Yeah, totally. Send them a link. Do it while you're right there on the phone with them. Boom. No checks required. Credit card link. Bam, bam.
Why are loan officers so afraid of consumers nowadays? I feel like loan officers are more afraid of consumers than they were when I was a loan officer. Is that I don't know. That's just my feeling. Could be wrong.
Well, consumers are armed with more information than ever, and more options, and it's very easy to hang up the phone and click and get 2 more quotes. You can get someone on the phone. You can get a competitor on the phone in a heartbeat. So there's that, and originators have a right, to be shaky because they've got, our pull through. I haven't got my number yet from 24. It's probably about the same. And I've confirmed this with Zactus, who's our one of our 2 credit partners. And the national average is 18% pull through. So you pull credit reports, 18% of them turn into a funding. If you're consumer direct, it's less than 8%. So that's the fear, right? You have 5 conversations and 4 of them bear no fruit. And that's where that comes from. And that's part of the game. And people don't like losing. Right. So you just got to process it as learning. What did I do wrong to not convert that 82%? If anything, maybe they just, we went through the process and they couldn't qualify. So there's half of them wrong.
When you really think about that, 18% of pull through from credit pull to funding. So just so loan officers understand what that means is, Kevin is saying if you pull 5 credit reports, you're going to luckily fund one of those transactions.
That's right.
Right? I mean, in round numbers, right? We're rounding.
That's winning. That today is winning. Anything else is learning. Don't say win or lose. Win or learn.
Here's the thing, brother. If you really in my mind, this is the way I work, right? If you don't pull 5 credit reports, you can't even fund one deal.
That's right.
Right? So if you're pulling 15, you're going to fund 3. I mean, guys, this is the way this thing works. When you really start breaking it down, it's about the number of the activity. It has nothing to do with the rates, I believe. I mean, rates are important. Don't get me wrong, but it comes down to the activity that the LO is doing. Kev, what do you think?
100%. And if rates do come down, then maybe pull through goes to 25%, and that's 1 or 4, and then you feel like you're winning even more. But you can't process it in your mindset as I lost that deal. You're not going to get every deal, and so it's win or learn, not win or lose.
That's an awesome tip, man. I mean, just I think what happens is we just have to. It's a mind shift. It's the way our perception is, you know what I mean? Like if I really understand what Kevin Peranio just said here, which is just the gem of the whole show for me, right? Which is, dude, if you can close 1 out of 5, you're winning.
You're winning more than the average at 18%. when I talk to a consumer and they're not 33 years old and they're a first time home buyer, which I think the age creeped up to like 36. I've even heard 38. So we'll see how that reports. But when I talk to a consumer and they're talking about buying a house and they're under the age of 33, I tell them, I go, you're winning. You are winning the game of life. You're buying a home before most people buy their home. That is a win. And if you're 28 and you got 5 years of gaining equity before the average person buys their first home, you are winning. I love telling consumers that.
Awesome. You said something interesting in Florida, and I want to wrap this show up because we're coming up on that 40-minute mark. You said something interesting when we were in Florida on our last episode, where you said our children will not be able to buy the house that's close to the city, close to the ocean, close to the mountain, whatever it is. They need to move outward. Can you talk about that again? Because that was such a great statement you made back then.
I call it the starter home. So your first time home buyer, your starter home. You have to think about your first car. It was a piece of crap. You were just happy to have the wheels. Mine was a $4,000 paid in cash gold Chevrolet Corsica, 1989 Chevrolet Corsica that I got in 92 with manual roll-up windows, no tape deck, no CD, only a frickin' radio. And that was it. Now the next car that I bought on my own with my dad's help co-signing, but I paid for it, was a brand new Ford Explorer Sport. And it had all the bells and whistles. And I was so proud of the second home, And so your starter home is not necessarily where you want to be, near the ocean, near the city, near the restaurants, in the posh neighborhoods. Everyone wants to be there. You don't get there first time home buyer unless your parents stayed together and they got money and they give you money for a down payment and get you in the door. Boomer wealth is humongous. Something to ask your consumers when you're talking to them, how you get the down payment. Oh, my parents, da-da-da. I mean, I read 26%, or maybe it's 26 going to 27% of down payments come from a gift from parents. Sure. $150 trillion of wealth in America, 75 trillion of that is from boomers. And when the dad dies, because guys like us are stupid and we're definitely going to die first, boomer widows are going to control $105 trillion of net worth by 2030. So wow. It's big time, buddy. So the starter home is how you have to frame it. I mean, we've all seen the memes, right? We've all seen the memes. I want the $500,000 house, but I got $1,000 in the bank. I got the champagne taste with a beer budget. How do you frame that funniness into reality? You gotta, and I actually saw some on social media talk about the starter home. I've been using that phrase for years, decade. And I'm starting to see, and I put it out there like on shows like this on my LinkedIn so people can use it and steal these nuggets and bring it into their conversations and frame it in a way that makes sense to a first-time home buyer. We're working on your starter home, and you're going to build equity. You're going to build equity over time, and you're going to either sell it and put all that equity into the next house, and your next house is going to be even bigger and better or a better location. Or you're going to take money out and then, buy a rental property, rent that one out, and then, buy the next one, which is the double whammy, the Robert Kiyosaki rich dad, poor dad way of gaining wealth over time with renters paying for your equity in your retirement. So, that is the way you frame that conversation, just like we did in the last couple minutes, to separate yourself, even if you don't get the money for the credit card, to make sure that TBD doesn't go elsewhere.
Yeah. No, once again, I think, guys, if you're listening to this conversation and you want some tips, right now, that's another golden nugget for you. Because when the guy says, I want to buy a house here next to, outside of DC, but it doesn't fit their budget, we have to look and say, maybe you got to start 30 miles south first or 30 miles west first outside of DC. And then you can work your way back in if you choose to. Maybe you don't. Maybe it's fine out there. You know what I mean? But these are the kind of conversations that are tough to have. But if you're going to be someone's advisor when it comes to their mortgage transaction and not just a loan officer who takes a loan app and hopes that it'll stick to the wall, these are the differentials that are going to make the difference in 2025. What do you think, Kev?
100%. We can work from anywhere now. And maybe you got to go back to work. So now you got a longer commute if you're, a few miles away from where you want to be. Okay. Buy the car after closing, if you need another car, to make that commute. But you're right. These are the nuggets that you're all free to steal and use and close more loans.
Nice, nice. So listen, guys, we're going to wrap this live event up. Kevin, thank you so much for taking the time to be here. I know this was a things going on crazy out there, but stay safe, brother. You know, we're always wishing the best for you. Guys, if you don't have Kevin on your LinkedIn feed, you need to follow him, friend him, whatever, figure out where it is. But he's got some really golden nugget videos that come out on a regular basis. And just chock full of information that you can actually use. And obviously you want to share that with your consumers, because then you're going to sound as smart as KP just does. And you don't have to do all the research and reading that KP does, right? So that's the win-win. So Kevin, once again, brother, stay safe. Thank you so much for being out here. Guys, thank you so much for joining us on this live event. It'll be running back and forth. Always subscribe, share your thoughts about Life, Learn, and Need. We're starting our 6th season. So this is a kickoff of season 6, by the way, KP. I didn't tell you that.
Love it, Fabi. Love it.
Yeah, season 6, man. I'm dying here, Kev. I need
31 years and 6 seasons.
And with that, JP, get me out of here, my